December 31st, 2025. That's the day a massive tax increase hits American families without Congress voting, without the president signing anything, and without most people realizing what's coming. The changes arriving in 2026 will cost a typical middle-class family somewhere between $3,000 and $7,000 annually. Not because they did anything wrong, but because a law passed in 2017 is quietly expiring. Here's what almost nobody understands about how tax policy actually works in this country. When politicians want to make a tax cut look less expensive on paper, they write it with an expiration date. The public hears about the tax cut. They never hear about the built-in sunset clause that makes everything revert years later. The Tax Cuts and Jobs Act of 2017 included exactly this mechanism. Most provisions affecting individuals expire on December 31st, 2025. Come January 1st, 2026, the tax code snaps back to its previous form with some inflation adjustments. The impact isn't distributed equally. High earners lose some deductions but can adjust their strategies. Low earners see minimal change because they're already paying little or nothing in federal income tax. The crushing weight falls directly on the middle. Families earning between $75,000 and $250,000 face the most dramatic increases relative to their income. Let me walk through exactly what changes and why it matters to your specific situation. Tax brackets themselves are shifting upward. Right now, the 22% bracket covers income from roughly $44,000 to $95,000 for single filers. In 2026, that bracket disappears entirely. Income previously taxed at 22% gets taxed at 25%. The 12% bracket shrinks significantly, pushing more income into the 15% bracket. For a family earning $120,000, this bracket change alone adds about $1,200 to their annual tax bill. But that's just the beginning. The standard deduction is getting cut nearly in half. Right now, married couples filing jointly get a $27,700 standard deduction. That drops to approximately $15,000 in 2026 after inflation adjustments. This change is massive. It means $12,700 more of your income becomes taxable. You might think itemizing deductions would solve this problem. It won't, because itemizing got harder too. The state and local tax deduction, currently capped at $10,000, remains capped. Mortgage interest deduction limits stay in place. You're not getting relief by itemizing unless you have truly exceptional deductible expenses. The child tax credit gets slashed. Currently, it's $2,000 per child with $1,600 refundable. In 2026, it drops to $1,000 per child with different phase-out thresholds. A family with 2 kids just lost $2,000 in credits. Combined with everything else, the walls are closing in from multiple directions simultaneously. Here's where it gets particularly painful for specific groups. Small business owners who currently benefit from the 20% qualified business income deduction lose it entirely. If you're running a pass-through entity, an LLC, S-Corp, or sole proprietorship earning $150,000, you're currently deducting $30,000 before calculating taxes. That deduction vanishes. Your taxable income jumps by $30,000 overnight. Parents claiming the child and dependent care credit face reductions. The estate tax exemption drops from nearly $13 million per person to roughly $7 million. This barely affects the middle class directly, but it illustrates how comprehensive these expirations are. Almost every individual tax provision from 2017 is disappearing. Now, you're probably wondering why Congress doesn't just extend these provisions. The answer combines politics, budget constraints, and timing. Extending the tax cuts costs roughly $4 trillion over 10 years, according to current estimates. That's an enormous number that requires either spending cuts elsewhere, revenue increases from other sources, or accepting higher deficits. Both parties face difficult choices. Republicans generally support extension, but struggle to identify spending cuts that could offset the cost. Democrats face pressure from their base to let cuts for higher earners expire while protecting middle-class provisions. Splitting the difference requires negotiation and compromise that seems unlikely in the current political environment. The timing creates maximum chaos. We're heading into this with a presidential election year, potential government funding battles, and the usual congressional dysfunction. Even if there's political will to address this, the legislative calendar might not cooperate. Tax policy changes typically require months of committee work, debate, and reconciliation. We're running out of months. What makes this particularly insidious is the silence surrounding it. Most families have no idea this is coming. They're planning 2026 based on their current tax situation. They're not building an extra $4,000 or $6,000 into their budgets for increased tax bills. The shock will arrive with their first paycheck of 2026 when withholding suddenly increases, or worse, when they file their 2026 taxes in early 2027 and discover they owe substantially more than expected. I've seen this pattern before with other expiring provisions. People don't prepare because they don't know, and they don't know because this kind of sunset provision doesn't generate headlines until it's too late to adjust. The families who get hurt worst are those living paycheck to paycheck at middle-class income levels. An extra $400 or $500 monthly tax bill isn't an inconvenience. It's a crisis that forces impossible decisions about which necessities to cut. So, what can you actually do about this before 2026 arrives? What strategies exist to minimize the damage? First, accelerate income into 2025 if you have any control over timing. If you're expecting a year-end bonus, try to receive it before December 31st. If you're self-employed and typically invoice in early January, consider invoicing in late December instead. If you're planning to sell investments with gains, execute those sales in 2025 rather than waiting. The logic is straightforward. Lock in gains and income at current lower rates before higher rates kick in. This strategy has limits, obviously. Most people can't dramatically shift their W-2 income timing, but even small accelerations help. That $10,000 bonus taxed at 22% instead of 24% saves $200. It's not life-changing, but it's real money you'd otherwise surrender. Second, defer deductions into 2026 when they'll be more valuable. This sounds backwards until you think it through. If deductions save you 24% in 2026 versus 22% in 2025, you want them in 2026. Property tax payments, charitable contributions, business expenses if you're self-employed, anything discretionary should shift forward if possible. Pay that January mortgage payment in January instead of December. Make your charitable donation in January instead of December. The percentage difference in your tax bracket makes 2026 deductions worth more than 2025 deductions for most people. Third, max out retirement contributions while the limits are still favorable. The 401k contribution limit for 2025 is $23,000 if you're under 50, $30,500 if you're over 50. These contributions reduce your taxable income at current rates. Every dollar you contribute is a dollar that avoids both current taxes and the higher 2026 rates on that income. If you're not maxing out your 401k and you have any ability to increase contributions, do it now. The tax savings compound with the investment growth to create substantial value. Fourth, consider Roth conversions in 2025. This is counterintuitive because conversions create taxable income, but the math can work beautifully. If you have traditional IRA money, converting it to Roth means paying taxes now at current rates rather than later at potentially higher rates. You're essentially locking in today's tax treatment. The sweet spot is people who can convert amounts that stay within their current bracket without bumping into the next one. A couple in the 22% bracket might convert $50,000 from traditional to Roth, paying $11,000 in taxes now to avoid paying $12,000 or more later. Fifth, harvest tax losses before year-end if you have investments in taxable accounts. Selling positions with losses generates capital losses you can use to offset gains. You can deduct up to $3,000 of excess losses against ordinary income annually. This strategy works every year, but it's particularly valuable in 2025 because you're offsetting income at current lower rates. Sell the losing position, wait 31 days to avoid wash sale rules, then buy it back if you still want the exposure. Now, let's address what happens if Congress actually does something. 3 scenarios could play out. Scenario 1 is full extension. Congress extends all the individual provisions permanently or for another decade. Your taxes stay roughly where they are now. This would be the cleanest outcome, but requires the most political agreement and accepts the largest deficit impact. Scenario 2 is partial extension. Congress extends some provisions while letting others expire. Maybe they protect the standard deduction and lower brackets while letting other pieces sunset. This creates winners and losers based on which provisions affect you most. It's the most likely scenario because it allows both parties to claim partial victory. Scenario 3 is complete expiration with retroactive fix. Congress does nothing before January 1st, the provisions expire, then months later they pass something retroactive. This happened with other tax provisions before. It creates maximum chaos because employers have to adjust withholding twice, tax software has to be updated multiple times, and everyone faces uncertainty about what they actually owe. Avoid assuming this won't happen. Congressional dysfunction has produced this exact outcome repeatedly. Regardless of which scenario unfolds, you need to prepare for the worst while hoping for the best. That means building a tax cushion into your 2026 budget right now. Calculate what your taxes might look like under full expiration. Most people will see increases between $2,000 and $8,000 depending on income and family size. Start setting that money aside monthly. If Congress extends everything and you don't need it, great, you've got extra savings. If they don't extend and you haven't prepared, you're facing a crisis. Check your withholding in January 2026 regardless of what happens. If provisions expire, your employer should adjust withholding to reflect the new reality. But payroll systems make mistakes, especially during major tax law changes. Verify that your withholding actually increased appropriately. The last thing you want is to underpay all year and face a massive tax bill in April 2027. Talk to your accountant or tax preparer now, not in March 2026. Most tax professionals are slammed during tax season and can't give you the attention this deserves. A November or December 2025 meeting lets you plan properly while they have time to think through your specific situation. If you don't have a tax professional and your situation is even moderately complex, this might be the year to hire one. What's coming isn't theoretical anymore. We're months away from the biggest tax increase on the middle class in recent history, unless Congress acts. You might be wondering whether there's any chance Congress actually extends these provisions. Let me give you the realistic odds based on how Washington actually works. The political incentive to extend is enormous. Nobody wants to campaign in 2026 having just raised taxes on 60% of American households. But the mechanics of getting it done are complicated. Extensions cost money in congressional scoring, even though most economists argue keeping current law shouldn't count as a cost. The Committee for a Responsible Federal Budget estimates extending everything adds roughly $4 trillion to deficits over 10 years. That number forces Congress into uncomfortable choices. They can extend everything and accept massive deficit impact. They can pay for extensions by raising other taxes or cutting spending, which creates different political problems. Or they can do partial extensions and pick winners and losers. None of these options are easy, which is why we're heading toward deadline drama. The most likely outcome involves a combination approach. Protect the most popular provisions like standard deduction and brackets. Let some business provisions expire to reduce the cost. Add some new revenue raisers that sound good politically. Package it all together in early 2025 and claim fiscal responsibility while protecting families. But likely doesn't mean certain. Congressional dysfunction is real. Narrow majorities make compromise difficult, and politicians routinely misjudge how much voters actually care about specific tax provisions until it's too late. Plan for the possibility that nothing happens until after expiration. Beyond the immediate 2026 question, these expiring provisions reveal something bigger about how tax policy works in America now. We've moved away from stable, predictable tax codes toward temporary provisions that require constant renewal. This creates perpetual uncertainty that makes long-term planning nearly impossible. Every major tax bill in the last 25 years has included temporary provisions. They expire, we panic, Congress extends them at the last minute, and we repeat the cycle. The individual provisions expiring in 2026 were themselves extensions of earlier temporary provisions. This isn't sustainable tax policy. It's manufactured crisis on a regular schedule. You can't control whether Congress fixes this pattern. You can control whether you're prepared for the consequences when they don't. Financial resilience means building enough margin that you can absorb tax increases without derailing your entire plan. That margin comes from the fundamentals we've discussed throughout. Keep housing costs reasonable relative to income. Maintain adequate emergency reserves. Avoid financing consumption on credit. Invest consistently regardless of political uncertainty. These basics protect you whether tax rates go up, down, or sideways. The specific 2026 situation also highlights why tax diversification matters. If all your retirement money sits in traditional accounts, you're completely exposed to whatever rates exist when you withdraw. Having some Roth money, some taxable accounts, and some traditional creates flexibility. You can pull from whichever bucket makes the most sense given the tax environment when you actually need the money. Consider accelerating Roth conversions in 2025 for exactly this reason. Convert traditional IRA money to Roth while rates are lower. You pay tax at 2025 rates on the conversion. The money then grows tax-free and comes out tax-free regardless of what rates do later. If rates jump in 2026 and stay elevated, you've permanently avoided that higher taxation on everything you converted. The conversion strategy works particularly well if you're in a temporary low-income year. Maybe you're between jobs. Maybe you retired early and haven't started Social Security yet. Maybe you took a sabbatical. Convert aggressively during these low-bracket years. You pay minimal tax to move the money and protect yourself from higher rates later. One more consideration that connects to the expiring provisions. Estate planning gets more complex when exemption amounts are uncertain. The estate tax exemption roughly doubles under current law compared to pre-2018 levels. If that provision expires, many more estates face taxation. If you're anywhere close to exemption levels, work with an estate attorney in 2025. Techniques exist to lock in current higher exemptions, even if they drop later. But these strategies require action before expiration, not after. Waiting until 2026 when exemptions are lower means you've missed the planning window. The broader lesson here is that tax law uncertainty demands proactive response, not paralysis. You can't know exactly what Congress will do. You can know what happens if they do nothing. And you can prepare for that scenario while remaining flexible enough to adjust if they actually extend provisions. Check your withholding early in 2026. Set aside extra money for potential tax increases. Review your Roth conversion opportunities before year-end 2025. Understand which provisions matter most to your specific situation. Have a conversation with a tax professional who can run the numbers for your circumstances. Most importantly, don't assume everything will work out just because it usually does. Tax provisions have expired before when Congress couldn't agree on extensions. The alternative minimum tax hit millions of additional families during periods when Congress delayed acting. Payroll tax holidays ended abruptly. Other temporary provisions disappeared despite widespread assumption they'd be extended. The 2026 expiration is real. The impact on your taxes is calculable, and the time to prepare is now, while you still have options. What you do in the next 13 months determines whether you face this prepared or scrambling. The difference between families who weather this and families who get crushed comes down to what they do in the next few months. Not next year when the damage is done. Not when their first 2026 paycheck arrives with shocking withholding. Right now, while there's still time to accelerate income, defer deductions, max out contributions, and build the cushion that turns a crisis into an inconvenience. The tax increase is coming. Whether it destroys your budget or barely registers depends entirely on the choices you make before this year ends.